offers an enticing possibility for turning your business idea into reality, especially if you're short on personal capital, lack meaningful assets to pledge against loans, and don't have a network of investors or fellow entrepreneurs to tap into. Although historically, more often than not, I've been wary of my clients' proposed use of crowdfunding, and more than once I've had to break the news to them that it would be a material breach of an existing contractual agreement to pursue it, I do understand the appeal. So today, I'm going to push through my pre-existing biases to help give you a framework to assess before you launch your campaign the critical question, am I doing this legally? Because whether you're using platforms like Kickstarter, Indiegogo, or equity crowdfunding sites, there are legal traps that, if you're not careful, can derail your campaign and tank your brilliant idea before it ever has the chance to gain traction. In this video, I'll briefly talk you through the legal side of crowdfunding, what's allowed, what's not, and how to protect yourself and your business as you raise funds. As always, this is just a quick and dirty primer for general educational purposes. It's not legal advice, and you absolutely must engage your own attorney who understands the specifics of your situation before proceeding. Let's begin by reviewing the three main categories of crowdfunding and some of the key legal considerations associated with each. First, we have reward-based crowdfunding. These are platforms like Kickstarter or Indiegogo, where supporters can donate money toward your idea in exchange for rewards like special products and prototypes, early access or early bird pricing, and whatever other perks you can think up. A few key legal considerations for reward-based crowdfunding. When you launch a reward-based campaign, the statements and promises you make about your product, things like its features, quality, and delivery timeline, can create legal obligations. If you fail to deliver, or if you significantly deviate from your original promises, backers could claim that you engaged in deceptive trade practices. Misleading statements may also lead to complaints filed with consumer protection agencies like the FTC. Especially if you're an inventor who's just starting off with a concept, some specs, and maybe a very basic prototype, I do understand that evolution of your project is a natural part of the design process. But be transparent and certainly don't make any willfully false or misleading statements about what you can deliver and when. Now, funds received through rewards-based campaigns are typically considered taxable income by the IRS unless they qualify as loans or capital contributions. Even if you haven't officially started selling your product yet, the money is often treated as pre-sales revenue. It's important to consult with a CPA to determine how and when these funds should be reported and to prepare for potential tax liabilities. And if you're trying to get campaign contributions to count as loans or capital contributions, you absolutely need to get an experienced lawyer involved from the start. That's not the kind of thing that you can wing it or try to force after the fact. Backers who receive rewards in exchange for their contributions may be considered customers under consumer protection laws. This is a necessary and corresponding implication of my previous statement that the rewards may be considered sales. This means that you must handle delays, defects, or non-delivery of promised rewards carefully to avoid lawsuits or negative publicity. Transparency is key. Regular updates to your backers can help manage expectations and reduce risk. Next, let's review equity crowdfunding, wherein investors will receive an ownership stake in your business in exchange for their contribution through platforms like WeFund or StartEngine. So, full disclosure, equity crowdfunding has been my personal sticking point, and it has not yet made sense for any of the clients who are interested in it. For example, this has been a continued non-starter for my franchisee clients. Franchise contracts will vary, But in all of my cases, the agreements had a strict prohibition about any sale or transfer of equity interest whatsoever, including some requirements of disclosure and consent for even offering profit sharing interests without any voting rights or equity. And as you'll see in the key legal considerations we're about to discuss, if you are already constantly complaining about legal fees, CPA fees, and the administrative burden of federal, state, and local registrations, don't be surprised if your lawyer suggests that you're not temperamentally suited for equity crowdfunding. First and foremost, you need to understand that equity crowdfunding is heavily regulated under federal securities law because you are essentially offering securities to the public. Under regulation crowdfunding, your business can raise up to $5 million annually through a crowdfunding portal, but you must comply with strict SEC rules. We're just scratching the surface here, but among other things, you'll need to file a Form C, which includes disclosures about your company's financials, business risks, and ownership structure. Violations can result in penalties or being disqualified and barred from future fundraising. Don't discount the amount of effort involved in complying with disclosure requirements. Potential investors need to see detailed information about your business before deciding to invest. This includes your financial history, future projections, and potential risks. The disclosures you file are public, which means that competitors can see them too. But accurate, complete, and honest reporting is crucial to maintaining legal compliance, to say nothing of building trust with your investors. Make sure you have a sense of the effort and cost that this is going to entail before you commit yourself to the equity crowdfunding approach. And be aware that even after your campaign ends, you may still be required to file annual reports with the SEC, including updates on your financial condition and progress. Failing to meet these reporting obligations can lead to penalties or loss of investor confidence. Make sure you have a plan to maintain compliance even after the campaign closes. Do you have someone on your team with the requisite skills to manage this, or will this become another ongoing legal and accounting cost? Finally, let's briefly review donation-based crowdfunding, where donors can contribute to your cause without expecting anything in return. The most well-known platform for this is GoFundMe, and you probably associate it more with donations for personal matters, whether that's contributing toward the rebuilding of a beloved local fourth grade teacher's home after a natural disaster, or funding a consciously job-liberated freegan's soul-searching first-class trip to Nepal. But nothing is stopping you, per se, from using it to solicit donations for your new business idea. Just keep the following key legal considerations in mind. First, be mindful of the tax implications of a donations-based crowdfunding campaign if your business is the sponsor. When donors contribute to a personal campaign rather than to a business or nonprofit, the IRS generally treats those funds as personal gifts, which aren't taxable to the recipient. But if you're running the campaign under a business or a nonprofit, the contributions may constitute taxable income unless the organization qualifies as tax exempt, which, barring extraordinary circumstances, is probably not your profit-driven business. So, run your plan by your CPA early on in the process to get a sense of how much should be set aside to cover taxes. Some states regulate charitable solicitations, and donations-based crowdfunding for charitable causes can trigger registration requirements. I spent some time reviewing the business campaigns section of the GoFundMe platform in anticipation of this video, and many of those campaigns were in a gray area that seemed more like a charitable solicitation than a business proposition, at least to me. Now, non-compliance with state-level charitable solicitation regulations can result in fines or legal actions. If you are running a campaign that could be considered a fundraiser within the meaning of applicable state laws, Don't assume that willful ignorance is okay and you'll be able to stay off the regulator's radar. It's essential to understand your legal obligations before launching. Finally, just as a reminder that donation-based crowdfunding campaigns can face scrutiny if they're perceived as fraudulent and or misleading. This doesn't need to be as egregious as posting a fundraiser to rebuild the neighborhood coffee shop you run after it's destroyed by a fire, and then using the donations to put a new pool in your backyard. If your fundraiser's stated purpose is securing a new space in the neighborhood for the coffee shop and refurbishing it, but you instead use half the donated money as a relief fund for your staff to give them a stipend while they're out of work as you rebuild, this could trigger an investigation no matter how benevolent your intentions are, since you're failing to use the money for its originally stated purpose. Transparency and regular updates to donors, including giving them a clear sense of how their money will be used if your original objective has been achieved, can help avoid reputational and legal risks. If you're still excited about the prospect of crowdfunding your business, that's great. Let's briefly, and I actually mean it for once, we're going to keep it brief, summarize a handful of key legal issues in crowdfunding that will be relevant to essentially all business-related campaigns. Every crowdfunding platform has terms and conditions that you must follow, from project eligibility to prohibited activities. So read the fine print before launching to avoid having your campaign taken down midway through. Now, I know this sounds painfully obvious, but as I was researching for this video, even I learned a few new things. Kickstarter, for example, has a list of prohibited projects, some of which are totally unsurprising, things like weapons or pornographic material, and some of which only made sense after some reflection, things like energy drinks, medical devices, or GMOs. If your project is in a heavily regulated industry, regardless of platform, your best bet is to get it cleared in advance or else risk countless hours of futile work when your account gets banned for violating terms of service. Sharing your idea publicly exposes you to the risk of copycats. I've emphasized repeatedly how all of these platforms require truthful descriptions of what you're offering and accurate and complete disclosures relating to certain financial matters. NDAs aren't an option for crowdfunding, and the more you share, the easier it is for someone with more capital and more experience to snatch your idea and bring it to the marketplace more quickly. You must take all necessary measures to protect your intellectual property in advance, including filing for patents, copyrights, and even trademarks before launching. While transparency is key, you don't need to disclose your trade secrets to the public. So be honest, but avoid sharing proprietary details unless it is strictly necessary. An IP lawyer can help guide you through the analysis. And to quickly reiterate what we covered in the first segment of the video, if you promise rewards or perks, you may be held to consumer protection laws. Don't promise what you don't reasonably believe that you can deliver, and be realistic and honest about your timeline. Be transparent about risks and delays to protect yourself from legal complaints. Offering equity, that is, ownership stakes in your business, triggers securities laws, even for small campaigns. Be mindful of SEC registration requirements, annual dollar limits on your campaigns, and advertising rules relating to how you promote your offering. Of all the crowdfunding mechanisms, equity campaigns are where I most strongly urge you to consult an attorney in advance. Finally, don't forget your tax obligations. Crowdfunding money isn't free. It often comes with tax consequences. Reward-based campaigns generate taxable income unless very intentionally structured otherwise. And equity campaigns may require filing additional tax forms for investors. Work with a CPA or an attorney or both to ensure optimal tax treatment for your campaign funds and proper remission of whatever is due to the IRS or other taxing authority. Crowdfunding is a powerful tool to raise funds for your business, but it comes with responsibilities. Understanding the legalities and preparing ahead can save you from costly mistakes. Plan before you launch. Draft clear and realistic campaign goals and timelines, and research legal and tax obligations specific to your campaign type. Use reputable platforms, which may have much of the necessary framework already in place to keep you on track towards staying compliant. Consult professionals. A little investment of money with your lawyer and your accountant up front can save you several times over in the long run. And finally, keep documentation. Maintaining complete records of all funds received, backer communications, and expenses. With proper advanced planning, even a skeptic like me can see how crowdfunding platforms can get your business that infusion of capital that might not be accessible to you anywhere else and help launch your venture to the next stage.